Welcome to CRE Fast 5. Today's discussion is on key due diligence considerations when you're purchasing a property. I'm Carly Iacono. Now, today's information is a little less exciting than some of our other episodes, but it is incredibly important. For those of you new to commercial real estate, due diligence refers to the period of time in which you have to investigate or review your potential acquisition before your deposit becomes non-refundable. In net lease, due diligence is often a period of 21 or 30 calendar days immediately after contract signing. Now, as you know, I cannot give you legal advice, so be sure to work hand in hand with your trusted commercial real estate attorney during your due diligence period. The main categories we're going to touch on today are lease review, CAM, title, zoning, and physical due diligence, such as environmental inspections, property condition assessments, and surveys. Okay, let's jump into point 1, lease review. In addition to the fully executed lease, be sure to obtain all related documents, including lease amendments and guarantees. Review each lease to make sure that the rent and other key business terms match what is stated in the marketing materials. Make sure there are no future rent concessions or tenant improvement allowances that have not already been paid. This is especially relevant for new construction investments. Next, understand the sales and financial reporting requirements of the tenant. If sales and/or financial reporting is expected or allowed under the lease, ask for copies of the latest reports if they've not already been provided to you. Next, review the lease assignment and subletting provisions of each lease and understand under what circumstances the tenant is absolved of obligations, if any. Finally, determine if the tenant has any early termination rights or rent abatement rights under the lease. Note that unless the net lease property you're buying is a sale leaseback, it is unlikely you will be able to change the lease, but you still need to understand as much of it as possible, as a lot of the security in net lease property is tied to the lease itself. Next, you'll want to look closely at any common area maintenance charges or capital improvement costs that are not reimbursed by the tenant. Now, this really goes hand in hand with your lease review. If you have any landlord obligations, however minimal, get clear on what the cost of those obligations may be long-term, and be sure it's something that you're comfortable with. Just because a tenant reimburses for common area maintenance costs does not necessarily mean that they are the ones performing the work. For example, you may be responsible for hiring contractors to maintain the landscaping, and the tenant would then reimburse you for those costs. In other cases, the tenant may coordinate and pay for these services directly. If your net lease property is an out parcel to a shopping center, be sure to understand your obligations to the greater center, if any, especially if these are not reimbursed by the tenant. For example, do you have costs associated with the pylon signs in the front of the shopping center, or shared driveways, etc.? The next item is your title review. A thorough title review looks at all documents recorded against a property that may bind you as a future owner. This is an incredibly important part of the process and something you'll need to work closely with your attorney on. Any title concerns will need to be resolved prior to closing. The next important item is zoning. You want to analyze your property's zoning requirements and determine whether there are any non-compliance or non-conforming uses. If the property is benefiting from any grandfathered protection, determine what restrictions will apply to any future alterations, expansions, or reconstructions. Again, especially with a net lease property, this is not something you're going to change, but it's valuable to understand, especially if you plan to hold the property through the end of the current tenant's lease term, or if you're purchasing a property with the expectation of redeveloping it in the near term. Last but not least is your physical due diligence. A Phase 1 environmental assessment is ordered in almost every transaction. This will tell you if the property has any recognized environmental concerns or RECs, which could signal ongoing environmental liability for you. If wrecks are found, you may need to perform a phase 2, which includes on-site testing. You'll also want to make sure you have an updated survey to review. An ALTA survey is typically recommended as it ties into title review and will identify any easements, encroachments, discrepancies, and legal descriptions, etc. In addition to the phase 1 and survey, you may want to get a property condition assessment done as well. PCAs are often required by lenders. However, even if you're purchasing all cash, you may want to have the inspection completed so you know if there is any deferred maintenance that needs to be addressed with the tenant or paid by the landlord down the road. Many buyers purchasing newer construction or absolute net lease properties choose not to get a PCA done because the tenant is responsible for all maintenance. Now, if roof and structure falls to you as the landlord and your property is not new construction, you should consider inspecting the roof at a minimum to understand the remaining useful life. Now, if you're new to commercial real estate, due diligence can seem very overwhelming. This is where your deal team really matters. If you're considering an acquisition, feel free to give me a call. I'm happy to help you get through it smoothly. That was CRE Fast 5. I'm Carly Iacono. I'll see you next week.